Hi CA students, let's revise CA Final AFM Security Valuation Chapter 5 Practical Question 4. On the basis of following information, current dividend D0 is given 2.25, which is dividend at the beginning of the year, and discount rate KE is given 10.5%, growth rate G is given 2%. They are asking us to calculate the present value of ABC Limited. Now, since using this information, we can use dividend discount model. So D0 into 1 plus G divided by KE minus G. Using that formula, 2.5 into 1 plus 2% divided by the KE minus growth. So we are getting a value of rupees 30. Going to the second requirement, is it stocks overvalued if stock price is 35? Return on equity 9% and EPS is 2.25. Show detailed calculation using PE multiple approach and earnings growth model. So here also there are two requirements in the second requirement. So let's go one by one. PE multiple approach. So PE is nothing but price earning approach. So price earning ratio, we know the formula EPS into since we need the theoretical market price of the share to compare it with the stock price. So how will we calculate theoretical market price? So theoretical market price MPS equal to EPS into PE ratio, since we have to use PE multiplier approach, and EPS we can they have already given 2.25. we need to find out PE ratio. For PE ratio we have return on equity, but actually PE ratio, the formula will be 1 minus retention rate divided by return on equity minus growth. Here we are assuming there is no retention and it is 100% growth, or we are ignoring those values. Hence the retention portion will be considered as 0 and growth will be also considered 0. Why growth will be 0? Because if nothing is retained in the company, then it is assumed that the growth will be 0, because G equal to ROE into the retention ratio B, which again will come up to 0. So 1 by R we can take, keeping these assumptions. ICAI has not specifically mentioned that this was assumed, but in case if in question they have given retention ratio and growth, we have to use this formula. Otherwise we can go ahead with whatever ICAI is given. So I think they will give a details in the RTP or something. We have to wait. So P multiple 1 by they have directly given return on equity, but ideally it should be 1 minus B and R minus G, then 1 minus, as I told, retention is 0 and growth also 0, so 1 by R we can take, which will come up to 1 by 9% ROE. 11.11 we are getting as the PE multiple. So now this PE multiple again will multiply with the EPS to get the theoretical market price of the share, which is coming up to 25. As we can see, the theoretical market price which we found out using PE multiple is 25 rupees, but the stock price in the current market is 35, so which seems to be overvalued. Since actual stock price is higher, hence it is overvalued. So the position should be, we should sell the shares immediately, because the price can again stabilize or equalize at any point, thus it will go to 25. Now going to the second requirement, earnings growth model. So the actual stock price is 35, same, and return on equity is 9%. EPS we know that it is 2.25. Earnings growth model is nothing but dividend growth model. Same way, instead of this D0 we can take EPS. So EPS multiplied 1 plus G and divided by KE minus G, we are getting a value of 32.79. Now comparing it with the actual stock price, again here it is overvalued, because the theoretical market price is 32.79, but the actual stock price is 35. So the market will stabilize and the price, the share price will go down to 32.79. So it is suggestible to sell the share immediately. Thank you.